Hello everyone, welcome back to Corporate Decoder, the place where we decode the sometimes confusing world of corporate filings. Today we're diving into an 8K report from Intrusion Inc. It's a bit like finding out your neighbour took out a second mortgage, which might be exciting or concerning depending on how well you know them. Scroll form 2, 8K scroll form or current report tells us about some important events that Intrusion Inc., a company that specializes in cybersecurity, experienced recently. Think of it as their way of keeping everyone in the loop about big changes. First up, let's discuss an agreement they made called a Standby Equity Purchase Agreement, or CPR, with a company called Streeterville Capital. Basically, this ACPR gives Intrusion the option, the right but not the obligation, to sell up to $10 million worth of their own stock to Streeterville Capital. It's like having a credit line, but instead of borrowing money, they're offering shares of their company. This agreement started in July of 2024. The agreement is for 2 years. This is important because Intrusion can decide when and if they want to use this option to sell shares to Streeterville Capital during that time frame. In March of 2025, Intrusion filed some extra paperwork saying that they might sell up to $7.9 million of these shares. This doesn't mean they're definitely going to do it, but they're getting ready just in case. Scroll. Intrusion gives no immediate plans to draw upon the ACPEG scroll. Go for now. Here's a key takeaway. Intrusion says they don't currently plan to use this agreement, so why have it? Well, it gives them flexibility. If they need cash quickly, they have this option available. It's like having an emergency fund. Next, let's talk about another deal they made. On March 13, 2025, Intrusion exchanged $150,000 worth of a promissory note, which is basically an IOU for some of their own stock. They gave 153,295 shares of their stock in return for the 5 shares of their stock in return for the 5 shares of their stock in return for this note. This is like cancelling a debt by giving away a piece of the company. The company is not selling shares to get money. It is instead selling shares to cancel a debt it owes. This is important because it reduces the company's debt, but it also means there are more shares of the company out there. That could dilute the value of existing shares, making each share worth a little less. Finally, there are some exhibits or extra documents attached to this report. These include a legal opinion about the stock and an agreement related to that debt exchange we just talked about. Now let's take a look at the big picture. Intrusion is a cybersecurity company that's making some moves to manage its finances. They have a standby agreement to sell stock if they need cash, and they've exchanged some debt for stock ARCed. What does this mean for the company? On the plus side, the standby agreement gives them flexibility and a safety net. The debt exchange reduces their obligations. But there are also potential downsides. Selling more stock can dilute the value of existing shares. It also signals that the company needs more cash to operate. It is possible that they are planning for a rainy day, or it could mean that their product is not selling well. Overall, Intrusion's moves seem like a mix of cautious planning and debt management. It's something to keep an eye on if you're following the company because it could signal future moves by the company. Thanks for watching. If you found this breakdown helpful, please like, comment and subscribe for more corporate deep dives.